Hi, everybody. Welcome to episode 3 of the Plan, Protect, Invest podcast, the Scroy Lolly podcast. I'm here with Matt McNulty and Hayden Mumbach. And this month, we are going to talk about why you should talk to a financial advisor, when you should talk to a financial advisor, and some of the ins and outs of what we do as financial advisors to help create a little bit more clarity for you, the client or the potential client, to know when you should give us a call. So Hayden, one of the big things that we experience on our side of the desk is some hesitance to see a planner or a lack of knowledge as to what we do or how we can help. So what are some of the things that you think should be communicated to clients to show what we do and tell them how we do it?
So there definitely tends to be people waiting too long to seek planners, I think we see. So what really happens is people usually come to you when things are more urgent and they need help right away. But in contrast, really the best time to see a planner is, I say, when things are going good and you want to make them great, right? Stability is your friend and it's also our friend, right? So time is sort of your greatest ally in a lot of areas of investing, but also with financial planner, it gives you the most options we see, right? So we really think it's best for people, even if things are going good, to come in when things are stable. Let's review, let's get a plan in place before we get to that urgent.
Oh, I feel like there's a big misconception out there with what we do as advisors and, even so much what we don't do as advisors too, I think is ultimately, important. A lot of people might not fully understand, what we do and what we don't do. So Hayden, can you kind of take us through what, a financial advisor does and also what a financial advisor shouldn't really be used for either?
Yeah, so there's definitely a difference between a financial advisor or a financial planner and someone who invests your money, right? So with a financial advisor, what you're really getting is, of course, you're getting the investment management, but more so, you're getting retirement planning, tax planning, estate planning, budgeting and cash flow, insurance, really, like you like to say, anything with a dollar sign, we help with. Now, I think part of the reason people conceive that is because a lot of times the fee comes from the investment accounts, right? But the way I like to think about it is it's really an all-in-one fee, because what you're getting with that is, sort of everything we just mentioned. But more so, another myth that I think we see with financial planning is that you have to be rich to work with a financial planner, right? It's only for the ultra wealthy. Definitely not true, especially for us at Scroy Lolly, right? We have no minimums, right? So anybody who's over the age of 18, we're happy to work with, take a review, look at what's going on, see where we can help you, right? You don't have to have $1 million to have a financial planner.
So Hayden, there are some preconceived notions as to what a financial planner does and does not do. And can you get into, how we work with a client and how we do things that, kind of distances us from, those portrayals and other, negative things that may be floating around out there?
Yeah, so we definitely saw in the past a lot of people were just throwing around the term financial advisor who really weren't. But luckily, what we've seen as time goes on is there's more restrictions to use that title. So now you have to have a Series 65 license to say you're a financial advisor, kind of create more clarity there of, what are you really separating who does what from just, pure salesman. But more so going into what we don't do is, like you just mentioned, things like that with, sometimes people think we do day trading, some margin, some options. And, while margin and options are viable financial tools, they're not really financial advisor tools, right? That's what you'll see more at, a hedge fund or a brokerage firm, maybe just a regular investment manager. But with financial advisor, I think what you really want to think of is long-term wealth, right? Like you like to say, accountability, right? We're kind of a guide and a partner to take you along the ride for your financial goals in the most efficient and effective way possible. We're not here to, make a quick buck, buy these options, these margins, or day trade, anything like that. That's not us. What we're here to do is help you reach your goals and complete everything you need to do to feel financially secure. So like I mentioned earlier, you have to have the Series 65 to call yourself an advisor, kind of help us designate us. But Matt, why don't you tell us a little bit more about some other designations to help you to find the right financial planner?
Yeah, I would say the gold standard for designations in our industry is the Certified Financial Planner designation, or CFP for short. And there's a couple of reasons why you would ideally, if you are going to work with a financial planner, you'd want to work with one who is a CFP or is, at a firm that has CFPs on staff. Is because basically it's a very rigorous process in order to get those three letters after your name. I know it's a process I've personally been through. I know it's a process you're currently going through, Hayden, and it's a process that many other advisors at our firm have gone through as well. Basically the bare minimum in order to get it is you do need to have a bachelor's degree, at least, in order to get it. And then on top of that, you need to also have an education, specifically in financial planning. This can be, a certificate program. That's personally what I had done, or it can even be like a bachelor's degree, master's degree, or a PhD program that is approved by the CFP board. I know, Hayden, you have a bachelor's degree that was, approved by them specifically in financial planning. So you need that education piece as well, in addition to passing a pretty rigorous exam as well. That's about a 6-hour long exam. I know personally for me, it took about a year to study for it and pass it. And then on top of that, you also need to pass an ethics piece as well, basically saying that you will be a fiduciary, which basically means that you legally have to act in the best interest of your clients. So getting back to the education piece of the CFP, the topics that are basically covered in it are not just the investment side. That's only, 1 out of 6 of the sections that, the CFP goes over, which again, that's, typically sure how advisors get compensated. But really, I would say, 15% of my client conversations are around investment specifically. The other 85% are around other areas which are covered in the CFP, like estate planning, like tax planning, like retirement planning, insurance, as well as, general financial planning, like budgeting, saving up that emergency fund, or saving for, a kid's college, all of those areas that, all kind of intertwine like a web to form your overall financial plan. And really, when it comes to the fiduciary piece, not only are we covered it with the CFP designation, is, an individual advisor, but our firm, we are an independent investment advisory firm. And with that too, we are all fiduciaries covered under that umbrella, which means that, yes, we have to legally act in the best interest of our clients. But, I take things, a little more simpler of approach when meeting with clients personally. I treat whoever I meet with like they're a family member or a friend. And I refuse to give anyone any advice that I wouldn't give either a family member or a friend, when I meet with them at the end of the day. That's the simplest way, I treat all my clients that I meet with. It's the easiest way to, give anyone advice.
Yeah, so now that we went over kind of what a financial planner does, what they don't do, Matt, why don't you tell us a little bit more about some big life events that could cause someone to want to meet with a financial planner?
Yeah. there are a lot of big life-changing events that really can spark that need to meet with a financial planner. Really, I say, whatever stage of life you're in, if you're 18 or older, it's probably a good idea to have, some financial advisor or planner in your corner, kind of helping you out. But there are certain, indeed, life events that really, I think, really spark that need to have that conversation. I think personally, the biggest one is around retirement planning. Personally, myself as an advisor, I think that's the area that I think I add the most to the client relationship is in retirement planning. That's the area I think I spend the most amount of time on. And again, it's the area that I think we can add the most value, to the relationship. And when it comes to retirement planning, it's not so much starting off right into retirement. It's more so leading someone into retirement. So it's going to be meeting with them while they're maybe a couple years out from actually retiring. If we haven't been working with them before, getting them set up. And it's basically running through their retirement plan, kind of seeing where they're at right now and seeing if they can actually feasibly retire in the next 3, 4, 5 or so years plus, where they can basically be able to maintain their same standard of living that they were used to having while they're working and be able to maintain that through retirement. I would say the biggest thing you want to protect in retirement is your standard of living. You don't want to have to retire, but then, kind of downsize your lifestyle necessarily. You want to be able to, ideally, right, in a perfect world, maintain that, throughout your total retirement. That's really going to get, most enjoyment out of life. And, when it comes to that, we really want to see, okay, can we, keep that going for you? We'll basically take a look, see what your income is right now, what you're kind of used to, netting, net of taxes, net of your retirement contributions that you're making, net of all these things that will probably be different in retirement. Your taxes are going to be different in retirement. You're not going to be saving for retirement when you're actually retired. So that's going to be another, savings piece there. So we kind of look at, the net of everything and see what you're actually used to getting net in your pocket and seeing what you'll actually net in retirement. So we'll look at, base one being your Social Security income. That's, base, income level for, majority of retirees. So we kind of look at that first, what that's going to be, for you, depending on when you retire. Also, depending on where you worked or where your spouse worked for their career, your pension as well, if that is an option or not. It all, again, depends on the employer that you're working for. But we can see, what you'd be getting per month in pension income. Some pensions offer what's called a lump sum, where instead of getting monthly income for the rest of your life, you basically can get a lump sum of money that you can move to a retirement account. And, sometimes it makes sense to take the monthly income. Sometimes it makes sense to maybe do the lump sum. Every situation, right, is different. So we can look at, the kind of those two pieces and see, when it might make sense to claim your Social Security benefits, when it might make sense to claim your pension or maybe take the lump sum, especially with pensions. If you're married, a lot of times they'll offer spousal benefits, with pension as well, where it will only provide income for you as the worker, but potentially also your spouse as well for their lifetime. So kind of figuring out, what option to take, based on your other income, as well as, in turn, your assets, right? So, we start with Social Security, pension, right? And then if you need any other, income generated beyond what those two would give you, then we might need to take some money out of a retirement account to supplement those other sources of income as well. So we'll look and say, okay, if we take out, right, X amount of dollars from your portfolio over your life expectancy, what does that do to the account? Does it spend it down, sooner rather than later? Does it, last your life expectancy plus some, where you'd be able to maybe leave a chunk of money to, beneficiaries or, kids, grandkids, whoever it might be, or charity. So, we can kind of look at all of that and, basically say, give you the thumbs up, thumbs down, or kind of thumbs in the middle as far as, will you be okay to retire? Will you be able to maintain your same standard of living? And, kind of in that same vein too, not only will we kind of get people leading up to retirement, but then also manage things through their retirement as well. So it's not just getting you there, it's also getting you through retirement as well. So life is very dynamic. The financial plan you set up before you retire is not going to be the same one that you're going to have into retirement, because things in life change, and your financial plan as a whole is very dynamic. It's constantly changing from year to year as things in your life change. So that's something that, we monitor every single year with our retired clients, see what we need to do, maybe make some adjustments. Maybe we can take out more money. Maybe we need to pull out, potentially less money depending on, certain, tax rules. That tax rules are very dynamic. So if we're, focusing on tax planning through their retirement, that changes, from year to year for sure.
Yeah, so good stuff there, Matt, kind of explaining some of people's most common questions, right? Do I have enough money to retire? How to make sure I don't run out of money in retirement? But let's get into some more specific things about what are the most beneficial accounts to pull from, kind of strategizing there, and also RMDs.
Mm-hmm. So when it comes to retirement, and if you do have, your assets built up in maybe various types of investment accounts, maybe you have some money in a traditional IRA, traditional 401k type of account. Maybe you have some money in a Roth IRA or Roth 401k, as well as maybe, some money in a brokerage account or an after-tax account. Well, we can basically help you determine, obviously depending on the size of those accounts and what proportion they are to one another, which one it might make sense to pull from first, depending on ultimately your goals, right? Depending on, who you want to leave the money to. Do you want to leave your heirs and beneficiaries a bunch of money that's taxable? Or would you rather leave them tax-free money that they won't have to pay taxes on, right? So depending ultimately on your goals, that's really going to determine what types of accounts we should spend down first, potentially, to basically leave those heirs and beneficiaries the more favored accounts. Again, all depending on your goals, which again is subjective to each person. Some people I meet with want to leave their beneficiaries, as much tax-free money as possible. Others are fine with saving the money on taxes during their lifetime and would rather have their beneficiaries pay the taxes. So again, every situation is different, which is why it's important to look at things more on an individual level when it comes to deciding what types of accounts to spend down or pull from first in retirement. And obviously, using most up-to-date tax rules, we can kind of use that in combination to do things from a very tax-efficient manner, depending on, again, whether or not you want to pay the taxes or you'd rather have your beneficiaries pay the taxes ultimately. So we look at things through kind of that lens. And so there's really not a, right or wrong answer with what type of accounts to spend down first. And when it comes to RMDs, that's something basically where the government says, all right, once you reach a certain age, this year the year you turn 73, you have to basically start taking a minimum amount out of your pre-tax retirement accounts, things like your traditional IRAs, traditional 401ks, your 403b, deferred comp, your traditional thrift savings plan. Those types of accounts, basically, you have to start taking a certain minimum amount out of each year. Now, for some people, maybe, your Social Security income and if you have a pension, Social Security and pension income has been enough for you to kind of live on and maintain your lifestyle. And maybe you haven't been pulling any money out of your retirement accounts for your whole retirement. And now all of a sudden at 73, you have to start taking out this chunk of money, deciding obviously what are options with that. Because if you don't maybe need the money, maybe you want to reinvest it elsewhere and going through, the options that we have with that. Or maybe you want to gift it, whether that's gifting it to kids or grandkids, family, friends, or maybe it's gifting it to a charity, right? And then there's some special favored tax advantages that we have if you do want to gift your RMD to a charity, which we can definitely help you out with. That's called a qualified charitable distribution. So if you are charitably inclined, there is a tax-efficient way to give your money to charity from your RMD that you'd have to take in retirement. And all these things, we can definitely help clients out with. And again, I think it's where we add the most value to the relationship for sure.
So retirement, one of those major mileposts that we see, in the horizon, for our clients. Another big one is marriage and unfortunately divorce. So why should a person come see us if they have gotten married or are thinking about getting divorced?
Yeah, right. Unfortunately, when you talk about marriage, you got to kind of talk about divorce along with it too, because they unfortunately kind of go together. But from a marriage side of things, that's really important because generally you're going to have two individuals who've been doing things individually themselves, through their adult lives up until this point. And basically, they have to come together, right? Come together as one, ideally. It can be very tough to manage money as a couple if you're both doing things differently. It's kind of like the right hand not knowing what the left hand's doing. Maybe one of the spouses is a saver and really wants to, save a lot of money. And then the other spouse is a spender. So it's kind of, each one sort of undoing each other's goals. And there's definitely a kind of a healthy balance to be found between, saving and spending and giving. You got to have that all balanced out. And that's where I think we can kind of help is kind of that second independent third party that's obviously outside of the relationship itself to help them really kind of come together, join their finances together and kind of get used to that process of doing things together. Because again, ideally, spouses would want to be on the same page as one another when it comes to their overall financial goals. And we kind of take things a step further with that. As far as, maybe one spouse has a better 401k or employer-sponsored plan than the other spouse, and maybe we want to take advantage of that one more so. Or maybe there's certain work benefits, whether it be like, health insurance and things like that through the one spouse that the other spouse maybe doesn't have access to. So kind of going through those things to figure out what's going to be more favorable for each, for not only each spouse, but then the couple as a whole, I think can be really beneficial when working with people who either are in the process of, getting married or who have, been recently married, kind of getting all their ducks in a row.
So that's the coming together. What about tearing apart.
Yeah, that's the tough part, with marriages, right? About 50% of marriages end in divorce. And of that, of the 50% that do end in divorce, the number one thing that they point to, that these couples point to for causing the divorce is typically money fights, money issues. Unfortunately, that seems to be the number one kind of cause for it, unfortunately. So that, again, going back to my previous point, why coming together, being on the same page, having a plan is so important, not only for your long-term goals, but also for your marriage as well. I think that's so important. But if you do find yourself in the point where, unfortunately, we are splitting apart as opposed to coming together, there's a lot that really goes into that. Obviously, depending on how long you guys are married for, there's different rules and things to be aware of there. But if you've had a couple that's been together for a long time, it can be very tough for one spouse or maybe even both spouses to get used to kind of, doing things themselves, right? Usually what I see, when we meet with couples is usually one of them, typically, again, not all the time, typically one spouse will be the one that's kind of in charge of managing the money, paying the bills, kind of, handling the financial plan. The other one's usually kind of like along for the ride. Maybe they're still on the same plan, but just sort of doing things, a little bit differently, or maybe not just quite as involved with the plan. So with that spouse, especially with the one who hasn't been maybe used to paying bills and just doing these things, maybe budgeting themselves, it can be really important for them to make sure that once the divorce happens, that they're in a good spot where they, can still have that a little bit of that financial freedom where they're not so reliant upon the other spouse doing all the financial planning for them, right? So that's, I think where we can kind of add a lot of value, as well as kind of from the logistical side of actually going through the divorce, whether it be, maybe you jointly owned a house with the spouse, and now maybe, one spouse is going to keep it, and then they have to pay you, right, a chunk of money for, let's say, half the value of the house. Or maybe there's a splitting of the retirement accounts through what's called a quadro, handling all of the kind of logistics with that of, actually processing all of the, paperwork and, all the legal matters that kind of go into that and setting up those accounts. We can kind of help you with that. And we've helped our clients with that, over the decades as well. So we can help on the logistical side of things, but also help more on the, emotional side of things, as well as getting things where if someone, again, isn't used to paying bills themselves and budgeting themselves and really managing finances themselves, again, being that strong party sort of in their corner, they're sort of cheerleader in the corner to, help them out and get them through that tough time. Divorce is one of the toughest things you can go through, right? It's like one of the 4 Ds in life. You got disease, disability, death, divorce. People rank those, the 4 hardest things, right, to kind of go through in life. So it is a very tough emotional thing to go through. And, if we can help on kind of the financial side of things, make things a little bit easier for you, I think that's wonderful for sure. And then kind of getting, away from, the retirement planning side of things and, marriage, divorce, another aspect that we can help our clients with is if they get an inheritance, kind of speaking to, those 4 Ds, death, unfortunately, being one of them. If someone does receive an inheritance, Matt, walk us through, how we can help them manage that.
So when a client receives an inheritance, no matter what people want to tell you, 9 times out of 10, it's relatively unexpected. You don't have it baked into your current financial plan. So it kind of comes out of nowhere. And for some, it is incredibly necessary and will help, raise all ships and, help raise the tide a little bit for them. For some people, it's icing on the cake. They don't necessarily need the money for their day-to-day. So that's the first big distinction, is figuring out, okay, do we need this money, or is this money something that we can, invest, plan with for the future for the particular client? The second biggest consideration of an inheritance and how it comes in is the form of it. So essentially, are you receiving it outright, or are you receiving it in trust? And are you receiving cash, or are you receiving stuff? So stocks, bonds, cars, houses, each one of those distinctions will basically tell us how we need to proceed, whether or not you need or want the money right away. The form of it is definitely going to pave the road for us as to how we can move forward. So first distinction received in trust or received outright. Received outright, you get it, it's in your name. You can do with it what you want, whether it's a share of a house, whether it's 500 shares of Apple, whether it's a car, whether it's cash. If you get it outright, it's yours. You get to do with what you want with it. There's no limitations. If you receive it in trust, it completely depends on what that trust says. So you may be able to receive it outright depending on how the trust is written, but most trusts I've experienced over my years have age limitations in there. So you have to be 25 to get X percent. You need to be 35 to get X percent. You need to be married. You need to have kids. Trusts come in all shapes and sizes. So you really have to go back to that trust to figure out what you can do with what you have been given, if you can do anything at all. Sometimes you can't do anything until you reach a certain age marker, or sometimes the trustee of that trust has complete discretion as to whether or not you are going to receive anything and what you are going to receive. So there can be a lot of roadblocks put in place on purpose if you receive things via trust. The other side of things is cash versus stuff. So cash, again, if you receive cash outright, you could go spend it, that same day. There's no limitations on you doing that. But if you receive stuff, whether it's in trust or outright, there are some more considerations in play there. The biggest one is, how much is that stuff worth? And if it is a capital asset like a security or a home, how much was it purchased for, and how much is it worth now? Because a lot of times in an inheritance setting, we see people receive very highly appreciated assets, be it a home, especially, in our Buffalo, New York area right now, we're seeing home prices tick up very steadily. So something that was purchased in the 70s for $60,000 might be selling for $400,000, $500,000 now, well beyond any of the exemption limits or anything like that for capital gains. So that's a huge consideration, because you don't want to go out and flip the house and all of a sudden be staring down a $250,000, tax liability for, selling the home. So that's something that we can come in and say, okay, tax planning, don't go out and flip that house, or don't go out and flip those GE shares that your grandma bought in 1976, because you're going to be paying a huge tax gain, a huge tax bill on the gain for, not necessarily no reason, but in a non-thoughtful manner. We want to be thoughtful about these things. We want to make sure that we're limiting any of the tax exposure that we can get for our clients. So that's the biggest thing that we can help with in an inheritance standpoint.
So Matt, just went over inheritance, kind of where we can step in and help there. Now, why don't you tell us a little bit about starting a business?
Yeah, starting a business could be a really life-changing event. Obviously, from an income standpoint, hopefully for the person that's starting a business, but it can change a lot of the administrative things that surround their life, like how they file their taxes, or succession planning, what to do with that business, how to hand that business off. So one way that we can really help is by, first off, bringing you in and working with one of our insurance licensed people to get what we call a buy-sell agreement. Especially for a small business, if you only have a couple of founders or owners, or however you want to frame them, a buy-sell agreement is something that one of our insurance licensed people can help with to make sure that you are you have a plan in place if anything were to happen to you or another one of your partners. It's a simple agreement that can be drafted by an attorney, and then the insurance professionals can help with the actual insurance itself. That basically ensures the life of one of the partners to basically have pay their way, to help pay whoever's receiving the shares, or to set up an agreement to make sure that those shares don't go to somebody that they don't want them to go to. So that's one way that we can help. Another way we can help is just by helping you pick what entity form you're going to choose. So entity form can definitely impact how you're getting paid, the expenses that you're able to take, how you're reporting your taxes. So LLC owners are not allowed to take a salary. So how do they get paid? They get paid via distribution or draw. So that's a very different setup than receiving a paycheck every week, or in filing your W-2 on your taxes at the end of the year. You're going to receive what's called a Form K-1 that has all the information you need, all the profit you made, all the expenses you have, all the capital gain you've generated depending on your business, your cost of goods sold, depending on what type of business you're in. All that is going to be housed on that Form K-1. Instead of filing a W-2, you're going to file the K-1. So that changes a lot about how a potential owner is going to file their taxes. The other tax piece is most owners are going to have to pay estimates on a quarterly basis versus having withholdings. That's a huge change for most people because you're no longer essentially cash flowing your taxes. You are, at the end of each quarter, you have to go and pay the government a set amount, typically based off of what the taxes you owed the year before. So that can be a huge change for people. So, helping set up a plan to, whether it's funnel money in over the course of the year into an account, essentially treat it like an escrow account to a certain degree. Money goes in to flow out to the government at some point, but to set those sorts of things up for clients, it can be really helpful. The other piece on the business side is, as an owner of a business, you definitely have a lot more options when it comes to retirement planning. In most cases, you cannot set up a 401k where you're going to have a percentage and you're going to have a match. Just doesn't work like that for owners. So there are options that we have for owners in terms of being able to set up an account for them and potentially their employees, depending on how many employees they have and how their people are employed, to create a retirement account where the owner is actually able to. So Matt spoke, last month about the new contribution limits. So the new contribution limit for a SEP IRA, for example, is $72,500 or 25% of the gross receipts, whichever is lower. That's obviously a nice chunk of money that can be, allocated to a retirement account that a non-owner would not be able to do. So it offers yourself more options that we can help you sit down with you and help you kind of game plan. Okay, does a simple IRA make more sense than a SEP IRA? The answer to that is usually no. But but most of the time we can walk through all the potential options you have, for retirement accounts to make sure that you, as a new business owner, are set up in operating correctly. So.
All right, so thank you everyone for joining us today in our February episode of Plan, Protect, Invest, Scroy Lolly podcast. Went over some good stuff today, what a financial planner does, what we don't do, when you should meet with us, those civic events. So if you have any more questions, feel free to reach us at 716-674-6700 or virtually on our website at scroylolly.com and schedule an appointment.